Welcome to StablePod, the podcast that explores the exciting world of decentralized systems and beyond. Join us as we delve into the limitless possibilities of decentralized governance, decentralized finance, and decentralized organizations with the most creative and innovative minds in the space. We'll hear from trailblazers who are building, shaping, and maintaining the future of these decentralized systems. From DAOs to NFTs, DeFi to Web3, we cover it all on StablePod. Welcome back to another episode of StablePod. I'm your host, Juan Esquivel. I'm joined by my lovely co-host, Gustav Ehrentoft. How are you today, Gustav?
Very good. I'm really excited to talk to my good friend and former boss, Greg, today. So all good here.
Yeah, it should be a fun one. Today's guest can be described as a protocol designer and founder, helping push forward the DeFi space. Greg Prisco is co-founder at Ajna Finance and M0 Labs, and the former head of business development at MakerDAO. Welcome to the podcast, Greg.
Thank you for having me, guys. And obviously good to see you again, Gustav.
I'd love to start things off with your journey. I think you have a very interesting journey that has greatly influenced your approach and your design philosophy. Could you walk us through your path that ultimately landed you where you are today?
And we only have 50 minutes. So I started out in college. I was my senior year of college in 2010, and I got interested in Bitcoin. And that, was my first foray into the crypto rabbit hole. I couldn't really do anything with it because I wasn't a developer and I didn't really have that much money. So it was more just watching Bitcoin. But when I got out of college, I went into trading. I was a commodity futures trader for about 6 years. But the whole time I was just, constantly on the internet researching crypto because I thought it was so much cooler than anything else going on. And in 2015, I finally made the leap with my boss at the time, now business partner, Joe Q. And we started the first ETF that was going to track the price of Ether. Now, naturally, the SEC did not approve that ETF, nor have they approved any ETF. But it was a good jumping point into the industry professionally. From there, we started Distributed Capital, which was one of the first crypto venture capital funds. It's still around. We still manage it. It's just a pretty passive fund. And during that process, we had our core portfolio investment that was MakerDAO. And at the time, Maker was just a bunch of guys in a chat room talking about this software they were going to build. And we decided that we loved it so much that we would join the team full time. So right before they launched the original single collateral version of DAI, I came on as their head of business development, and my business partner, Joe, came on as their head of trading and markets. And for the next 4.5 years, we helped to build DAI and grow out the Maker ecosystem. And that's also, of course, where I hired Gustav, which was a good move on my part, I think.
And not quite hired, directly to the BD team, but poached which is, our
I
CEO
feel like
at
Do hired
Stable
himself onto the BD team more.
yeah, that's another quite funny story, but maybe for another time.
Yeah, I'm curious, during your time at MakerDAO, what do you think was like the main things that influenced you and where you are today? We'll get into Ajna in a bit, but I'm just curious, like, to hear more about that journey during your time at MakerDAO and kind of what you saw and kind of what has influenced you the most.
Well, I still think that the vision of Maker is where the space ultimately needs to go. The original vision of Maker. I don't really know what the vision is anymore, but back when I started, it was the idea that anybody could be their own bank. So I think to appreciate Maker, you had to have a little bit of an idea of how banking worked, which most people don't and didn't. But I was coming from finance, so I was able to see it very clearly. And I think that's why I landed the biz dev job in the first place, because I was one of the few people that could actually articulate MakerDAO to non-Solidity developers. And the vision there was always, imagine there's this software you could use. And as long as it knows the price of the assets you hold, you can print your own money, which is exactly what a bank does. You walk into a bank, they look at your assets and they say, okay, we'll print you this much money. But you need their permission, and it becomes a very centralized process. And obviously, I was originally interested in Bitcoin because of my libertarian leanings. It becomes a great place for the government to control your life. So I was always just implicitly against the fiat banking system, and also was very disillusioned with the government because this was all during the great financial crisis. And I just saw the whole way it was unfolding as just hopelessly corrupt. And I thought that this technology was the best way to solve it. Now, that was the naive perspective I went into MakerDAO with. Coming out 4.5 years later, I realized, okay, that vision is great, but from where we are today to actually being able to implement that vision at scale, we are light years from that. I mean, we're talking like the distance between the Milky Way and Andromeda. Like, it is far. So that's when I started setting my sights on building other protocols, because I think there's a lot of intermediary infrastructure that needs to get built before we can realize that final vision.
So something about MakerDAO is obviously that it's very org heavy, like at least, the previous iteration. Did you just not like, did you see that as more as friction and you're more interested in the tech itself? Because I know Maker gets this flack for just kind of over indexing or maybe over relying on this like people, right? People. And then I know there's a philosophical debate in DeFi. There's the people oriented organizations, startup-esque protocols. And then there's the maybe where you sit, which is more, I just care about the technology, creating, a protocol that's not, there's human resistant, capture resistant. I don't know if you have any response or takes there.
Unfortunately, I think there's a lot of nuance to the point. I wish there was an easy answer where you could just say people are bad, get them out of the protocol, or people are good, let's just run everything like a startup. But the answer is always going to be somewhere in between, because there's certain things you just can't do without people. I mean, this was one of the core lessons from Maker, that we tried to make it a completely automated system, and it just doesn't work, at least not today. The problem, though, with Maker is that it's not resilient. So the people that control it, they're known, they're predictable, they're fixed. They have, potentially conflicting incentives with a lot of other people in the protocol. So I think that it just wasn't designed in a way that was, if you are going to incorporate people into your design, it needs to be very carefully thought out. And the attack surface of the people in Maker was too big. So, to get to that vision of everyone being their own bank, you really need it. You need to get away from governance, because if you have governance, it's going to get corrupted. I mean, like, think about the reason we wanted that in the first place. We didn't like the government, right? Like, we just replaced the government with a bunch of internet nods. That's a horrible idea.
Yeah. So to get into specifics, I know during your time at Maker, you're probably best known for leading the charge for real world assets. Correct me if I'm wrong. It seems that, given the current high interest rate environment, your kind of push for this has kind of been proven right.
I think this is one of my secret claims to fame, that I'm pretty sure that I introduced the term real world assets into the crypto space. And I deeply regret that. I mean, it's such a stupid phrase. It makes no sense.
Right. There's people that say real world assets are also stable coins, right? Like anything that's pegged to a USD or to a fiat currency is also considered. So the term is kind of
what is a real world
misunderstood.
Real world as opposed to what? I started saying it that way because I was exclusively talking to crypto people, and I needed a way to differentiate between crypto native assets and assets that were not crypto native. And for their worldview, a non-crypto native asset wasn't real. So I had to actually insert the word real into the phrase and say real world assets, things that you didn't make out that of thin air.
Yeah. So could you maybe give us a quick history lesson on what you tried to achieve with this during your time at MakerDAO, and what you saw, what was your biggest barrier? Because I think in the end, the lesson was that you couldn't really achieve what you wanted to achieve based on structural reasons, organizational reasons, etc.
Oh, no, it's just impossible to achieve what I wanted to achieve. I mean, the reason that we took the path down towards real world assets was because that's inevitable. You cannot have a stable coin with global demand without having a commensurate amount of global assets to back it. The idea that you could back a stable coin just with ETH is complete nonsense. I don't even have to qualify that as being my opinion. That's math. You can't do it. Eventually, the demand will outstrip the supply of ETH, and then you have a big problem. Or you can put crushing negative interest rates like RAI, and then I think you need to revisit your definition of a stable coin if your stable coin depreciates 30% a year. But the true answer is I think we were all on this collective journey to learn exactly what money was, because a lot of people still don't even really have a strong opinion on that. Is an opinion, right? Money is kind of in the eye of the beholder sometimes. But what we learned is that whatever your unit of account is, let's say it's dollars, the only thing that you want to hold as a saver is something that is perfectly substitutable with that unit of account or perfectly usable as a unit of account. And in the real world, that's treasuries. It's short-term T-bills, or it's reserves at the Fed, which you don't have access to. So the closest thing we can do to approximate a US dollar is make the collateral exclusively short-term US treasuries. And that's, as you're seeing, that's where every stablecoin is pivoting, because that fundamentally is what money is in our world. It's not bank deposits.
Yeah. So, I mean, I think like, of course there is like, I think like a lot of other branches around like real world assets that, you know, is also like being explored. Right. And I of course like know a lot of like the troubles that we ran into during our time at Maker with this specific topic. But like kind of like looking at this and, you know, knowing your story at Maker and seeing, you know, what you're building now with M0, and the same thing, knowing your story around, you know, governance and the friction and frustrations you had there, and then seeing what you're doing with Ajna. Maybe you can be like a little bit more direct and kind of like, you know, the specific ways that, you know, your past there had like inspired you to improve upon like your two new ventures.
Yeah, well, I'll talk about Ajna mainly because M0 is still in development. But when I left the Maker Foundation in April of 2021, I was obviously very frustrated with the governance process, mainly because I saw Maker as this blank slate that you could do so many things with. And the primary impediment to dealing with it was the governance. Obviously, it had other problems, and Maker is a whole different animal because it has a stable coin. But at the time, as I mentioned, my business partner, Joe, was running the trading desk at the foundation, and they were operating all over DeFi. And another big problem we saw was that within DeFi itself, there was a hard scalability limit that was being caused by oracles and governance. So if you wanted to like what would happen is you'd have a new asset issuer come out of the market. That asset issuer would need liquidity. Obviously, if it was at the Maker Foundation, the desk would want to provide liquidity and DAI. But that's when you'd start hitting the hurdles. So provide liquidity where? Where are you going to get inventory? It basically put you down this labyrinth where you needed to go and pitch a DAO like Aave or Compound for 3 to 9 months that they should add your asset as collateral. And then they would have all these requirements and there'd be all this politics. And even after all that was done, you needed a liquid secondary market because you needed to have an oracle. And the only way you can have a price oracle is if you have a secondary market that's more liquid than the primary market you're trying to facilitate via lending. So when we left the foundation together, we said, we need to fix this. How could we do that? Well, we need to build a lending protocol that kind of like Uniswap is for trading, doesn't use oracles in order to price the collateral. And little did we know what a journey that was going to be. But 2.5 years later, here we are. And Ajna is pretty much done, and it's about to be redeployed on mainnet. And the whole point of Ajna, like every design decision that we made, and unfortunately, Ajna is a very complex protocol, but I'll get to that in a minute. Every design decision that we made was around removing the need for centralized price feeds in the protocol.
So maybe this is a good point to actually define what Ajna is. Maybe for some of the listeners that have heard of Ajna, see that it's a lending protocol, but maybe you could actually articulate why it's unique, what it brings to the table that's novel and more interesting than the current lending protocol space.
So I like to compare Ajna to Uniswap. We think of it like Uniswap for lending. It's a place where you as a user can go and spin up a pool that has any arbitrary asset pairing. So you could spin it up for ETH to DAI. You could spin it up for a bored ape to ETH. Truly any two assets you want to use for lending and borrowing. And you can do that in one click, and then you have a lending market. The software manages everything else for you. The only thing you need to do as a user is decide the price that you want to lend against the collateral at. So if you're going to that ETH to DAI pool, you need to input the price that you're willing to lend at. So if you think that you're comfortable lending against ETH at 1,000 DAI per ETH, then you'd go to the pool and you'd deposit at 1,000 and you'd leave it there until you felt like the market was either too close or too far from where you deposited.
So this all sounds incredibly complex. Maybe for you, because you're well aware of how the inner workings work. To you, it's pretty straightforward. But I know there's a lot of back and forth in terms of designing protocols for the end user in mind, making the UX as seamless and simple as possible. Was that considered in this process of designing Ajna?
I'll be honest, not really, because there's only, from my perspective, there was only one way to design Ajna, and it took us a long time to arrive at it. But like I said, everything we did was in service of removing the need for that centralized price oracle. Once you've done that, yeah, you end up with a lot of complexity because oracles are extremely complex mechanisms. I would doubt that many people could tell what's under the hood of a Chainlink oracle or a chronicled oracle or and any of the major oracle providers in DeFi today. Like they are doing extremely advanced stuff behind the scenes, and that complexity just has to exist. Whenever you're trying to get a real-time price from one source to another that aren't connected, that is going to be a complex process if you want it to be secure. So that complexity has to live somewhere. In most DeFi protocols, it lives outside the protocol, it lives with the oracle, and they take on that trust assumption to have it. Ajna said, no, we want that to be outside the protocol, not in the protocol. So in order to do that, we had to build the complexity into the protocol. And I think if you look at the complexity in Ajna versus some of the centralized oracle providers, Ajna is actually orders of magnitude less complex. But compared to other DeFi protocols that get to abstract all that complexity to a third party, a trusted third party, it looks complex. But our answer to your question is front ends. So we think front ends should handle this complexity for users. We don't want them making risk decisions on behalf of users, but they can abstract away a lot of the weird stuff to automation that the user would just do kind of like a robot.
Yeah. I just want to note your Uniswap analogy. I think it's interesting because I noted in some of their recent comms and some of the communication and material they've put out recently that they're switching over from having people consider Uniswap as an application layer protocol, like an app, to like, I think they describe it now as like a marketplace or more of like a, I forgot what the term that they use, but I thought it was very in line with what you just described, which is like, it's the front ends. It's just the protocol is the back end, and it's up to these front ends to basically serve the UI UX to the end user.
Yeah, what you see happening is that protocols are running into this complexity barrier, where in the past they were able to abstract away a lot of the complexity, mainly through governance and oracles. So if you think about the other way a protocol can abstract complexity, governance. All right, users are not going to want to, let's use compounder Aave as an example. So users don't want to manage LTVs. Users don't want to worry about utilization and interest rates, et cetera. So let's abstract that to governance and let this group of people decide. But all of these things are, I like to think of them as a scalability curve. So if you think about a DeFi protocol that abstracts all of the complexity away to governance and oracles, that scales really well when it launches, and then starts to trend towards scaling really poorly as you try to grow. Something like Ajna is going to be the opposite. It's going to have a lot of friction when it launches because the front ends have to get the abstractions correct. The users need to start to conceptualize some of these new flows. But as it scales, it really hardens into something that's very, very simple. Because once all of those things start to solidify, you have an immutable base layer primitive that'll never change on you, and you could build on it forever.
Yeah, I think like a good example here to also look at is kind of like if you look at something which is centrally managed as well, which you could say that like for example like asset listings on like Maker, Aave, and Compound is right, like centralized exchanges and like when they list assets on trading, right? I think like on Uniswap, I don't know what they have today exactly, but I remember maybe like a year and a half ago, looked and they had like over 35,000 pairs. Today, that might be even higher, right? Where like if you have any centralized management of anything, it will be extremely difficult to get above, especially when it's borrowing and lending, where you have to constantly sit and manage the rates to get above, even just like, I think Maker was like getting super complex when there was like 15 or 20 asset types in Maker, right? Where it was crazy the amount of work required from delegates, right? On like a weekly basis, it was a full-time job. And even then, you weren't able to manage it in the best way. I think we can all agree on that.
Yeah, I think that DeFi is heading in the right direction. The stuff we're building today, I hope will be the blue chips of tomorrow. And I think you're seeing the blue chips of today start to kind of wake up and smell the coffee and adapt. Like you've seen Rune put Maker through this enormous shift of strategy. And I think it's in retrospect, he looks pretty smart for it because Maker had to change. Maker just could not scale in its original implementation.
Yeah, and it was funny actually because when the endgame plan kind of like came out in the beginning, everyone was like, really giving a lot of, I think, like negative comments about like, like this was too big of a change, it was too complex, it was not proven. But now, it looks to actually be like planning out as kind of like intended. And it's also trying to, especially exactly as you're saying, Greg, kind of like trying to break some of these things down in smaller pieces, right? They don't use, sub-DAOs rather than necessarily like, the abstraction for front ends, but I think that, kind of like moving in that direction is also like a sign of maturity, right? I just think there's still like a lot of protocols that maybe haven't arrived at that point yet.
They will. The market will push them there. But also just to comment on the Uniswap analogy. So Gustav pointed out that Uniswap has like 1,500 trading pairs or something. And notice also...
like over 30,000.
Oh, 30,000. Like, wow.
Yeah. I don't know how much it is today, but it was like, I think it's like a year and a half or 2 years ago I looked at it. And that was like over 30,000 pairs.
Wow.
Yeah.
Well, Ajna supports NFTs too. So hopefully we'll have more. But my point was going to be that notice also that Uniswap does more volume than Coinbase for Ethereum related assets. So I think it kind of proves the model that if you can capture and this is more of a go-to-market business perspective, but if you can capture an asset in its infancy, once you get the liquidity, it's not going to leave you. It's not going to be like, oh, this asset started on Ajna and that became its primary lending market because Ajna had it when it had a $1 million market cap. And then, it has $1 billion market cap. Now it's going to go to Aave and live its life there. It's going to stay on Ajna. Just like an asset that starts its life in a Uniswap pool doesn't suddenly become more liquid on Coinbase. It stays in the Uniswap pool because that's what liquidity was. And market makers or, even I guess passive liquidity providers, they just don't care that much. Like they have access to most of these venues and they just want the easiest experience. So that's our bet.
I was going to ask a related question to that a little bit further, but I think it's good to ask right now. So I think you described liquidity as a moat. Correct me if I'm wrong. For some of these protocols, it's your core moat. It's something that differentiates you, right? So related to Ajna, it's governance free, Oracle free. It means it's not upgradable. So we've talked to other people in the space when there is a vulnerability, which we can also touch on what happened at Ajna with that. The liquidity is hard. It's not easy to move. So I guess my question to you is, proponents of governance will say that we need that upgradability to enable liquidity to be able to move around in case there's something goes bad. But you're designing something in the opposite field where it's a lot harder to be able to move that liquidity in cases that things go awry. Do you have a respond or take there?
Yeah, I mean, think about what they're really saying. They're saying we need this ability to control your funds like a regulated institution so that you don't have to pay attention. I mean, that's literally why we have financial regulators. Like financial regulators exist for that exact paradigm where an issuer or a financial services company says, give me your money. You don't have to pay attention. I will take care of it. And there's so many things that go wrong in that relationship that we needed this entire regulatory apparatus to be put on top of it. Whereas with a real protocol, the concept is, you have to pay attention. You're an individual. You're responsible for yourself, but we can never touch your money. We can't pause it. We can't steal it. We can't freeze it. Like that. You're just using code that you can go audit yourself, and you are entirely responsible for what happens next. And I mean, I really think if that's not the paradigm that we land on, what the hell was the point of this? Like, why are we here and why did we build crypto if we're just building the exact same systems that we had with like less efficient governance models?
I mean, I must, also make the counterpoint here that, of course, just by using the blockchain itself, we do get a lot of improvements already compared to the traditional system, right? I do agree that, like, some of the specifically borrowing and lending markets is like what we're talking about here, right? Because I think, like, a lot of other points in crypto, and I think, whether you like how Maker, is governed or not, like DAI is still immensely valuable as just a stable coin that you can like use, and there's no restrictions on DAI itself. You could say that there's something in the back end which could go wrong because of the governance, but I still believe that it's better than like what we had before, right? I do think though that also just kind of to go back to the point of like whether we had these systems and upgradeability, right? I think like once there's some things in protocols which kind of like upgradability is often like a security argument, and security is something which, after like a certain period of time, you can kind of like assume that the protocol is just like, secure enough, right? I think that, it's really only like in the beginning where you want to have this kind of like upgradability, or even, like delays in like governance implementations or things like this, or no delays in governance implementation, sorry, like this, because, there might be like a bug in the code. But I think like after like a while, you would be able to like assume that, unless some groundbreaking new revelations happens around how we interact with, Solidity, for example, then, the code should be deemed somewhat secure. I think like just to kind of top on that, like at what point would you feel safe about like, Ajna, kind of like from that standpoint? At what point do you hope that Ajna like scales to what you want to see it scale like?
Yeah, well, you made me realize now that I misspoke. So there's two moats in DeFi. One is liquidity, the other is security. And I think this is why it's very hard for new protocols to crack into a market, because if you have two options and they have relatively similar functionality, you're going to go with the one that has been more battle tested, that has more TVL, that's been around there for longer, because the chance that there's a vulnerability is just very high. That's true for literally every. I mean, I don't think we've had a single DeFi protocol without one critical vulnerability. I think every single one has had one at some point. Actually, no, I'm sorry. Uniswap did not have one. Uniswap's like the pun intended, but the unicorn of that that paradigm. But yeah, I mean, for me, I feel safe with Ajna when we launch it again, because I understand it so well, and I've seen the 10 audits that we've gone through. But for an outside user, I think this is why things like yield farming are very useful. People have, the new rave is shitting all over yield farming and being like, oh, it's pointless. It's not a good strategy. I think people miss the point of yield farming. The point of yield farming is to reward these early users for the risk that they're taking by depositing into a new protocol. And in doing so, they provide that TVL that gives new people the confidence to come in later on saying, okay, this protocol has had this TVL for this period of time. So I think that's how Ajna will scale. Like, it'll take a while. And going back to my diagram, how like Ajna is inverse of what you'll see with these other governance-based protocols. Governance-based protocols, they are constantly upgrading their smart contracts. At a certain point, I don't know where the threshold is, it becomes exponentially more likely that you introduce a vulnerability via one of those upgrades than an immutable protocol that's been there and hasn't changed for all that time has one that's suddenly discovered.
I want to take a quick step back on Ajna before we get into the exploit and what what's going on now with the redeployment. I'm curious to hear from you, Greg. What was it like designing and I guess the initial launch of the protocol? What were the main takeaways that you learned in this multi-year long process? Maybe for individuals that are not really familiar with what it takes to design a protocol, at least in the way you envision it. So yeah, I'm just curious to hear if what were your biggest takeaways, things you learned along the way that you will carry with you going forward?
I literally only learned one lesson the whole time, and that is to avoid complexity like the plague. Any unnecessary complexity in your protocol will cause you hell for the rest of your life. It is just really terrible. And I think especially working so closely with the Solidity developers, you get an understanding of why. Like it is just complexity and protocols are just not compatible. And like to the extent you need complexity, yeah, you need it. And maybe that complexity can actually become an advantage later on. Like I think that's going to happen in Ajna. As I was saying earlier, the reason Uniswap stuck around and gets all this volume is because it has an asset in its infancy. Ajna is the only lending protocol that can capture new assets as they come out. Any other protocol that I'm aware of, they use oracles. There's no such thing as an oracle on an asset that was minted yesterday. That is physically impossible to do. So that asset has one place to go, and that's Ajna. And it's going to be really damn hard for somebody else to build a competing protocol to Ajna that doesn't use oracles because of that complexity. Because they're going to have to spend 2.5 years and millions of dollars on 10 audits in order to get there. So, I think that the whole auditability thing is very important. But complexity is horrible. But if you need it, you need it, and it can be a competitive advantage. You just need to know how to handle it.
Yeah, totally. All right, let's get into the griefing vulnerability that was found. Maybe speak a little bit to like the lead up to that point. what was identified, and then the what the fallout from that, and maybe where we are today now?
Yeah, so we originally launched the protocol in June of 2023. We had 6 audits up to that point, and most of them were looking at the protocol from a code security perspective, not so much a game theory perspective. I think when you hire these auditing firms, they're very engineering focused. They're not so much game theory focused. We had done our best in analyzing it from a game theory perspective. And about 2 months after we launched in August, we got an Immunify report from a white hat that said, hey, I figured out a way to add debt to people's positions that they don't want. And we're like, well, that's no good. Do you have an incentive to do that? Not really, but I can. So that's why we called it a grief. Like there was really not an economic incentive to do this to people. And I think that's why you never saw it happen, because it is like, you'll pay gas fees probably, and, you might go to jail or something for doing this. Probably not a lot of incentive to do it to somebody. But the fact that you could do it to somebody, and we're trying to be an immutable protocol that's around for 100 years, not for 2, we needed to make sure that there were absolutely no known flaws in the protocol. So what we did was we suggested, hey, everybody, please wind down your positions. Again, this goes back to like, if we were governance-based, we probably would have slapped a Band-Aid on it and been back up and running the next day. Here we are 3 months later. We're went through 4 more audits and are putting fixed reviews in this week. But yeah, it was a tough experience. Like it was a huge learning experience for me to deal with that. It's a horrible feeling when you have to ask, because we actually did really well. In 2 months, we got $30 million in TVL. And especially that the depths of the bear market, like I think that was really impressive. It shows that we had like immediate product market fit, and like everybody wanted to use it. There were so many people excited, and I really hope that that's still there when we relaunch in a couple of weeks. But yeah, we had to do the right thing, and nobody lost money. So that was my metric for success.
Yeah, I mean, I can only imagine kind of like how like problematic that also is, right? And I think this is like kind of going through, and would also say like really like would commend you guys for like what happened. And I think with something like this, I mean, the problem is that in today's day and age, like if you can grieve other people, people will do it. You can imagine the first time someone with a famous ENS borrows something in that situation, you can imagine someone sitting there and clapping their hands and adding that to that position. Or the Bored Ape markets, I mean, they would be destroyed. So like even with something like this, of course, you always need to do it right. Like even if it doesn't make sense to you, then like that someone would do this, like people would for sure do it.
Yeah, the threshold I use at least is, would I still use the protocol knowing that this is there? And if the answer is no, then we have to advise people to wind it down. I think my one request to the world is that maybe people can get a little more used to that, like that cycle, because you don't want to encourage governance. Governance is not scale. It's never going to work long term. There's plenty of room for participation of token holders in ecosystems, but changing the composition of smart contracts should not be one of those things. You can change parameters. You can vote on grants and on ecosystem building, but changing code should just not be what a delegate or what a token holder does. And I think that if people were just more accepting of having to pay attention to their positions, or having basically delegating that responsibility to a front end to pay attention to their position, then these protocols could ship immutably, because you generally do get a heads up when there is something wrong. Like you can put enough procedures in place where you could detect a problem, alert everyone you need to alert, and then as long as they're paying attention, they could wind down and put it back in the protocol as soon as it's back up.
But isn't there also like another problem here a little bit, which is that I think most of the DeFi protocols we see today are not like finished, like a lot of them are kind of like work in progress. And I know there's some, there's different iterations on how you build this out, right? I think, like with Ajna, you can like say, okay, the protocol is done. This is, it's perfect. So it's never going to get better. It's never going to get worse. You know exactly what you have. There's someone like, Aave who releases, like Aave V1, V2, V3, and kind of like, does it like this, where you also have to migrate, where you can kind of like say that the protocol is finished. But there's, for example, other ecosystems, like let's say on like the L2 side, where they continuously will want to improve the technology, improve the project and the protocol, right? So I guess it's not kind of like a one shoe fits all, right? Because I think there's definitely still some, projects that would want to not launch this and just say this is as it is, you can only use it like this, but who wants to do this like incremental improvements over time, right?
But there's nothing stopping people from that. I mean, even Ajna could do incremental improvements. You just need to launch a new version and the liquidity needs to go there. That's how Uniswap does it. That's how all the L2s that you just mentioned do it. That's how Ethereum does it. That's how Bitcoin does it. The only projects that don't do it that way are, for some reason, DeFi protocols who don't want users to opt in, but they want to make that decision on behalf of the user. And that's really what I take opposition to. I don't think token holders should make a major security decision on behalf of users.
So perhaps related to that, is it safe to say there's no multi-chain strategy here in place? It's up to the community to kind of be able to.
Oh no, we're redeploying on all the L2s. So because Ajna, each pool is isolated, it doesn't matter how many times it's been implemented across the chain. So we're gonna launch in a bunch of L2s along with mainnet.
Gotcha. And so coming back to
how just one question there. How does the L2 fees and money that Ajna earns around the entire ecosystem go back to the main treasury?
Yes. So the main treasury is only on mainnet, and the main Ajna token is only on mainnet. And the way that we engineered it is that if you want to, let me just give a quick explanation here. So the Ajna token, the way it's used in our system, it's the only currency that's accepted within the Ajna protocol to buy pool reserves. Every Ajna pool, as lending and borrowing takes place, accumulates reserves. These reserves actually need to be accumulated because otherwise it introduces some sort of frictionless loop that could be exploited. So we needed these fees. We needed origination fees, we needed deposit fees, and we needed a net interest margin. All three of those things, we could have burned them or we could have put them to use. So we decided to put them to use because burning would be very wasteful. But they needed to exist. That's my main point. The way that they are taken out of pools is the pool will accept Ajna tokens as a currency to buy the reserves. So anytime reserves accumulated in a pool, anybody can come and kick off a reserve auction, which starts a Dutch auction that begins at the entire supply of Ajna and then works its way down to whatever the market price is. So when we launch, there's going to be 1 billion Ajna tokens. That means that if there's reserves in a pool, when you kick off that reserve, it'll start and say, you can buy these reserves for 1 billion Ajna tokens. And after an hour, you could buy them for 500 million, another hour, 250 million. And eventually it'll get to a number of Ajna tokens that somebody is willing to send to the pool in exchange for the reserves. And when they do that, those Ajna tokens are irretrievably burned. They're gone. Now, the way we do that on L2s is we have contracts called burn wrapped Ajna. This is a one-way bridge to the L2 where you actually burn the Ajna on Ethereum beforehand and then can remint it on L2, but you can never come back. So the point is, if you're using this special contract, your only intent is to bring those Ajna tokens over to the L2 just to buy reserves, because you're never going to be able to leave with the Ajna tokens.
So perhaps related to that, Greg, could you explain for the listener that that wants to get involved once it's redeployed, maybe not as a borrower or lender, but as maybe this grant process, I believe that's outlined. Could you maybe explain what that is and what that aims to achieve?
Yeah. So back when we were a little more naive, we decided to also innovate on grants. So we built this pretty cool grant mechanism that uses I think it's square root, not technically quadratic, but it uses a more egalitarian method of voting so that you can distribute. The effect is that basically every Ajna token holder gets to distribute their share of the quarterly budget. The way it works is that once per quarter, there's this fixed, permanent, immutable cycle that will happen. And every 90 days, 3% of the treasury, which constitutes 30% of the total Ajna token supply that will ever exist, will be released to grants. And the way it's released is that there's 2 cycles. Cycle 1, everybody can submit a proposal. And this is just a simple 1 token, 1 vote. It happens for about 80 days, I believe, or 70 days. And the top 10 proposals make it to the second round. The second round is the fundraising round. And here is where we use that square root voting mechanism where everybody gets the sum of squares of their tokens. And what that translates to is that every Ajna token holder gets to allocate their share of the budget to those 10 proposals, however they see fit. So if you have 1% of the Ajna tokens, you can put 1% of that quarterly budget towards whatever you want, as long as it's one of the top 10 approved proposals. And we had to do that top 10 thing because otherwise people would just put in their own proposal and pay themselves. And also, one other interesting feature that I don't think you see elsewhere. We have negative votes. So this is where the combination of negative voting and having the sum of squares of tokens gets really interesting. Because if you think about what sum of squares of tokens means, you have the marginal cost of one vote elsewhere is very low to you. So if you put 99% of your tokens on one proposal, you're going to get, a good amount of votes there. But if you put even one token on another proposal, it's going to have a disproportionate effect because we're using the sum of squares, not just the ordinary sum. And I know these are probably math words that are going to go over a lot of people's heads. I understand that. You'll see it in practice. It'll be a lot more intuitive. The point is, if somebody's doing something you don't like, you can vote negative against them, and you don't have to spend that much of your money to do it, but you will have to take away from something that maybe you want to get funded.
Greg, so is it safe to say that maybe this process that you just illustrated is the form or the method that kind of produces Ajna's ecosystem? So maybe projects that want to work on top of it, within it, adjacent to it, this is the method that teams and will kind of go down.
Yeah, so after we redeploy, Ajna is not going to have a core team anymore. We're winding down our entity, we're disbanding. We think what's best for a decentralized protocol is not to have a centralized group of people that basically builds out the ecosystem in perpetuity. Because if you think about it, that's not a sustainable business model. You have no way of getting revenue. you have potentially a fixed supply of tokens that'll run out. You build a lot of dependency to this core group that then dissipates because the core group can't fund itself anymore. So just like the protocol itself, we want the ecosystem to scale in a similar way. Rocky at first, but then solid. And the way we think we can achieve that is through this innovative grants mechanism, where you don't have a winner-take-all majority rules mentality or even mechanism. You have the ability to come in and allocate your pro rata share of the budget as a token holder.
I want to shift over the conversation to some more philosophical questions. I wanted to ask you. I want to take advantage while I had you because I think you have very interesting perspective on DeFi and the philosophy of these protocols. So
and the best analogies.
Exactly. So I recently came across you published this piece. I think a few months back now. Basically talking about DeFi for first principles, building DeFi for first principles. And in the piece, you kind of describe that the D in DeFi is a farce. So I just kind of wanted to hear you expand on this idea. What has DeFi done that has led you to believe that the D in DeFi is not really, correct or we haven't gotten it right?
Well, I mean, I think having gotten it right is a little too soft, to be honest with you. Like, it doesn't exist. It's a lie. You cannot call something decentralized that uses a very small group of token holders to make all the decisions. That's not decentralization. That's a corporation. That's a corporation where the board has a considerable amount of control. I just don't even. I would counter it and say, what about the blue chip DeFi protocols of today? Do you believe is decentralized?
I mean, I think I think decentralization is something which is definitely the ultimate goal, and I think that some teams, I'm not saying all teams, but some teams definitely work towards that goal. But I think it comes a little bit back to also what I mentioned before, right? Which is that you have managed to build a protocol, Ajna, which is perfect in the sense that it's exactly as you want it to be today, right? And once it's relaunched, there's no changes that you think you could make to it that would make it better, right? I just don't think that a lot of protocols.
I think there's going to be a lot of changes we want to make to it. We can't make them, and I think it's a worthy trade-off because if you think about what it's going to look like in the future, sure, there'll be some feature improvement that we want to make. But is that feature improvement worth the security risk and worth the liquidity fragmentation that it would cause? Probably not.
I mean, but then you could say that you could have launched Ajna, let's say with upgradeability and a governance system that is controlled by the token holders for 1 or 2 years. You could have actually built Ajna up with build the liquidity up, probably maybe not the exact same levels, but let's just say I don't think right now we have it proven that a more decentralized protocol would attract more liquidity. I think a lot of the time users don't really care about decentralization, but you could have built this out for 1 or 2 years more, and then you could have launched the best product it could be with all the things you wanted in it, and then you could have removed control completely. And then it could have been.
You like my analogy, so you've seen the Lord of the Rings, right?
Yeah.
Do
Sure.
you know the metaphor of the Lord of the Rings? Like the ring of power. They don't want to give it up. There's never been an example of a group of people that have just altruistically given up a huge amount of power because it's the right thing to do. And I don't even trust myself or the team to do that. So now we don't have to. Like the point, like, do you honestly think any of these DeFi protocols, without some form of hard government intervention, are going to just burn the keys and say, this is it, it's done? No chance.
I mean, I don't know. I think that I know that there is some DeFi founders who actually want to leave the protocol and leave the project behind, right? And I think we've already kind of seen this tried in multiple scenarios where it, for one reason or the other, maybe didn't happen out exactly as that was supposed to be. But you get my point, right? I think like the idea of like saying like, oh, what we have today is kind of like, so perfect that we can be fully decentralized. It's just a very rare case. It takes a long time to build out
it's
the finance
the wrong
of the future.
reference frame, because the question isn't whether it's perfect today. It's whether it's good enough to last for the future and not be beaten by marginal improvements. And this is exactly what we see with any product that has a network effect. I mean, like, let's name a product like Twitter, right? Twitter's like the Hotel California. Like you could check out anytime you like, but you're never leaving. You're not going to Threads. You're not going to what's the new one? What's the stupid one? Mastodon. No one's going to Mastodon. You know why? Because Twitter has the network effect, and no marginal improvement you may make on Twitter is going to take you away because it's good enough. Now, if something comes along that's 10 times better than Twitter, absolutely, everyone's going to go to that. But short of that 10x improvement, which you can't prevent anyway with an upgrade, then you should have just stuck with good enough, and it would have been much better for everybody.
So are you based on that analogy of the way you just described that, are you accounting that the incremental progress we're going to make in DeFi is not going to 10x? New token standards, new mechanisms. Is that fair to say, the way you just described that?
I can't imagine a token standard that's 10x ERC20. I think we're going to be using ERC20 for a long, long time, just because it's like why do we use a certain gauge of railroad tracks? Like, are they the perfect gauge of railroad tracks? No, but they were good enough to get all the trains on them, and now we have trains. It's better to have trains everywhere than to have the perfect railroad tracks.
All right, gentlemen, I think we'll call it here. I know we could probably go on for another hour and throw a bunch of different analogies. So yeah, any final thoughts or anything you want to plug, Greg?
Well, I guess I'll give you guys a shout out. So I know that you're going to be one of our first Ajna delegates. So meaning a group that's available to delegate to if you are an Ajna token holder that will participate on your behalf in the grants process. And, knowing your team and knowing Gustav and Du for so long, like, I can't say that there's anyone I would trust more with that role. So I'm really glad you guys are in the ecosystem. And I'm very excited to see what you guys support in the process.
Yeah, we are. I think like, I think, of course, Greg, we might have different opinions on a couple of topics, but like in general, I think like what you guys have done with Ajna is incredible. And I can also play the devil's advocate because I believe so much in what you're doing. So yeah, like kind of like for us to be able to be part of it, we are super excited and it's going to be amazing.
Very cool. Well, thanks for having me on, guys. I really appreciate it.
Thank you so much, Greg. Thank you, Gustav. We'll see you on the next episode of StablePod.